today's going to be a very, I think, beginner type of class. I do have some things that I'm going to be going in depth on, like appraisal and stuff like that. But this is more so like as a newer agent, kind of understanding loan product or what type of loan products are out there. Obviously, besides the down payment assistance ones that I did a couple months ago for you guys, but more so just the basic, FHA conventional stuff like that that has like specific differences or a little bit of differences as to why we use one or the other in specific scenarios. Okay, so what we're going to cover today are pretty much 5 different programs: FHA, conventional, VA, bank statement program, and DSCR, which stands for debt service coverage ratio. It's the investor solution program. But that's what, when you're looking or when you see DSCR or you hear a loan officer say DSCR, that's what it is: debt service coverage ratio. And then things about the process, right? What it looks like from contract to close, kind of what those timelines are, so that way you're aware as well. When you're dealing with another loan officer, you're dealing with another company. The buyer came with their own pre-approval. They don't want to switch, whatever the case is. You're going to understand that flow. Appraisal, condos, which we did a in-depth condo presentation, which you guys should have the video for. If you haven't seen it, you should go watch it. That's where I kind of went over how to read a budget. And we went over like 4 or 5 different budgets in that presentation. So that way, if you have a client that is looking for a condo as well, you know what kind of questions to ask and what to look for. Employment change, rescores and credit, and then sourcing funds, kind of be like just little topics of concern and stuff like that, right? So I was a little bit inspired. We got I don't watch hockey, but we got the Florida Panthers in the Stanley Cup final, representing South Florida, basically. And we got the Miami Heat in the NBA finals, which I do watch. And we're 1-1 with Denver. So this is all pretty much Miami, Fort Lauderdale backdrops. So first thing is FHA. Okay, so pretty standard stuff, right? There's a lot of this stuff you may know, but if you do have any questions, any sort of scenarios, feel free to stop me. I want this specific presentation here not so much teaching you guys what you already know. Maybe you had a scenario or a conversation with someone else that said, hey, this and this happened, and we can kind of go over that. 3.5% down, minimum 580 credit usually. 100% funds can come from a gift, meaning that the buyer does not have to have any sort of money in their account, as long as there's really no negatives in their account. They can get 100% gift. Mortgage insurance is typically for the life of the loan, unless they put 10% down. If they put 10% down, that mortgage insurance will automatically go away after 10 years. So something that a lot of people don't know about FHA, because a lot of people assume that FHA is going to have that mortgage insurance for the life of the loan. And most of the times we say yes, because most of the time you're coming in with 3.5% down. But if you do come in with that 10%, you know that mortgage insurance is going to fall off. You're not going to have to refinance in the future if you don't want to or don't need to or anything like that. Very rare condo approvals. We talked about spot approvals as well on the condo presentation for FHA specifically, and kind of what they look for. It's a very, very tough process, but we have gotten them done in the past. You can do renovation loans with this as well. There is the FHA 203K, which I've done in the past as well here. Pretty much when you're looking at a FHA 203K or any sort of renovation loan, it's very simple. A lot of people think that there's more to it than what there actually is. And technically speaking, there is, right? The first step is going to be the same step across the board. Does the buyer qualify, right? That's number one. The only thing that gets added to that is now we're getting a contractor involved to do specific repairs in the property to make sure that property becomes FHA financeable. Number one, maybe it needs a new roof and you can't do it with FHA currently, and things like that, right? So that it's FHA financeable, or even if you're doing cosmetic things, right, you're getting that contractor involved. So really, you just need a bid from that contractor for the repairs that are going to be done, and the lender goes ahead and they do their background checks on the contractor. So they'll ask the contractor for their documentation, and now they're approving the contractor as well. So it's really the second step that kind of goes into the renovation loan. Is about now you have a contractor involved, and now that contractor has to be vetted. That's pretty much it. Lenient student loan guidelines. Okay, so before, I want to say, it was either 2020 or 2021 when FHA switched over their actual guidelines. Before, they were essentially, no matter what, we had to hit for 1%. Doesn't matter if they had an income-driven repayment plan at the time. It didn't matter for anything, right? Before, I believe, I don't know if it was 2020, 2021, but they switched over to where you can now use income-driven repayment plans, and it's no longer 1%, it's 0.5%. And a lot of people were able to qualify quickly after that because student loans are a big thing, big deal, and they're actually going to be restarting up very, very soon. Appraisals, they actually stick for 6 months now. This changed, I would say, probably about 6 months ago, maybe a little bit less or a little bit more. Before, it used to be 4 months, and that used to be the gripe as to why listing agents didn't want to accept offers, right? Because they're going to be like, oh, the appraisal sticks on the property for X amount of time, right? But what happens, right? And this is going to be a little bit of a sidetrack, but it's because I've had these conversations in the past, right? Okay, yes, the appraisal sticks on the property for 6 months. So you rather go conventional. What happens if that conventional appraisal doesn't come back the way that you want it? What are you going to do? You're going to accept another offer, and it's going to be conventional, right? It's literally the same thing with FHA. If that appraisal comes back and it's not where you want it to be, what are you going to do? Accept a conventional offer. The process is the same. Listing agents just don't think about that. It doesn't matter, right? If that appraisal comes in bad, whether it's FHA or conventional, you're still going to go ahead. The second step that you're going to take is accept a conventional offer anyway. So it's not too much of a big deal that it does stick for 6 months. It's better for the buyer ultimately, but it's not something that should sway people from picking FHA offers because the end result is pretty much the same. You don't like the appraised price, you're going to accept another offer, right? Conventional, the minimum is 3% down if you're a first-time home buyer. So not everybody can do 3% down. Specifically, only first-time home buyers are able to do 3% down. Everybody else does 5%. And usually that's the gauge that we're going to be looking at when we're talking about, trying to go use FHA or conventional, which one's going to be better for the client. Credit score minimum is 620. 100% funds can come from a gift as well. And we do not need a bank statement from the donor. So for FHA, we do need a 1-month bank statement from that donor showing that they have the funds in there. FHA is a government program. They just want to make sure that the client didn't have mattress money, like $5,000 that they gave to the person and the person gave it back to them. Conventional doesn't really care as long as it gets done correctly, right? You can't get a gift, whether it's FHA or conventional, and get it wired directly to your account and then tell the loan officer after. Right? The easiest way when we're looking at gifts, whether it's FHA or conventional, is for that person who's donating the gift to hold the money until the day of closing and wire it directly to the title company from the same account that they put on the gift letter. That is how you get around having to show the bank statement on conventional. If that gift donor sends the money to the client before and the client's under contract, the underwriter is going to see that large deposit. And now the underwriter has to trace that large deposit. Okay. So very important, whether it's FHA or conventional, to make sure that that gift donor gives that gift at closing and not at any time before, because things do get messy. Then there's a lot of paperwork that kind of goes into it. Right now we have to trace that money back to the other person's account. And now we have to ask the other person for updated transaction history and all that stuff. It becomes a headache. The easiest thing is directly from that person's account to the title company, and that's it. Monthly mortgage insurance can be removed or paid at closing. So if that client is coming in and they're saying, you know what, I want to do conventional, I'm going to do 10% down, we can do that, and then also give them the option to buy out their mortgage insurance upfront so that they don't have to have that monthly payment. Most of the time, it's not worth it. I would say a lot of the times it's not worth it because the amount of payment compared to what you're going to have to pay at closing doesn't really add up, right? If you are only paying $50 a month, but you have to pay $3,000 to get rid of it, right? It's going to take you 60 months basically to recoup that money. Doesn't make sense to do that, right? 10% down option for condos if reserves are bad. And I think we kind of went over this in the condo presentation as well, right? Is you can have your first Fannie Mae, your conventional loan has to be 75% loan to value. After that, you can get a second loan up to 89.99%. Fannie Mae does allow that, and Freddie Mac as well. There's also a renovation program available, very similar to FHA. It's called conventional home style, and they do the exact same process that I mentioned with FHA. You're just approving the contractor at that point. Nothing really extra to it. Lenient student loan guidelines. I actually forgot to go over this on the FHA one, so we'll kind of backtrack a little bit here. So you'll see here it says can be $0 payment on FHA because a lot of clients, they'll get the IDRs, and their IDRs are income driven repayment plan. Their income driven repayment plan is at 0. And if they're FHA, we can't use it. FHA's like guideline literally says, can use a payment that is above $0. Like it says it black and white. There's no way around it. So when somebody is approved FHA or pre-approved FHA and they need to get an income driven repayment plan, need to make sure that they ask the student loan people to please put a payment, $5, $10, anything. Because if it's at 0 and it's FHA, we still have to hit them for 0.5%. Adrian, I got you right now. And then appraisals don't stick and they can be transferred. So really a lot of lenders, and this is voluntary. So it depends on the lender. Us specifically, we'll transfer appraisals all day and we'll receive appraisals as well that were done from other companies. But I know like major banks, they do not transfer appraisals, especially if they're conventional. The only time those appraisals will get transferred is FHA, and that's because FHA requires it, and it's not voluntary. But conventional, it is voluntary, and a lot of times they will not transfer that appraisal. Depends on the company that you're working with and stuff like that. Adrian, you had a question?
Yes, I had a question. If you put the 10% down, do you still have to pay the mortgage protection insurance?
Yes. So the only way that you don't pay mortgage insurance is when you put 20% down.
Okay, gotcha.
Yeah. So it just becomes much cheaper the more you put down. That's it. Because the risk is much less for the lender. Usually the best, if a buyer has enough money, the best option is typically not 20% down. The best option is actually 15% down. And I'll tell you why. Because at 20% down, there is a loan level price adjustment because now the lender is not getting any sort of insurance, right? There's no protection. And so usually the rates are literally about 1/8 to 1/4 higher if you go from 20% or from 15 to 20%. But if you're at 15%, your mortgage insurance payment is pennies. Like you're talking about maybe 15, 20 bucks a month. So usually it's much better to do 15% if you have the option to do 15% down as opposed to 20, because you're going to get a better rate, and your mortgage insurance automatically you'll have enough equity within pretty much about a year to get rid of that. Yeah, as opposed to that interest rate, you're going to have that interest rate for X amount of time. Candace said, if there are no changes with pre-approved buyers' income or DTI, how long is a pre-approval good for? So typically that ranges depending on the lender or the loan officer you work with. Me, I do it as long as the credit report is active and I don't have to repull credit, right? Because if I have to repull credit and something changed, that could be an issue. So usually the credit report lasts about 120 days. It's about 4 months that we keep that pre-approval open. If that buyer is still looking, I will ask them and say, hey, I'm not going to repull credit because I don't know if you're going to find a property soon. And I'll let the realtor know, but has anything changed? Have you seen a decrease on your credit? Have you missed a payment? No, everything's pretty much the same. Okay, all right, keep looking. When you get under contract, I'll repull credit at that time. A lot of times buyers will get a little antsy if I tell them on day 121, if they're still looking, for us to repull credit. So I've done that in the past. It really just depends. I want to go back, I think. Okay, so yeah, the one thing that I want to say when I'm specifically looking at a buyer and I'm doing FHA or conventional and deciding, which one could be the best option for them. It's more so payment based, right? I don't care what listing agents want or what they're looking for. It's more so what's better for the buyer payment wise, right? And so the biggest fundamental difference between FHA and conventional is mortgage insurance. Okay. That's really the biggest difference. On FHA, your mortgage insurance is the same across the board. Doesn't matter if you're a 600 credit score or an 800 credit score. It's usually the same. Very recently, FHA lowered their mortgage insurance. It used to be 0.85% of the loan amount. Now it's 0.55%. So they took a huge cut off of their mortgage insurance, which is now helping buyers pretty much save on average about $100 a month, give or take, depending on their purchase price. With conventional, it does have weigh heavily on credit score and debt to income ratio. Right? Conventional is very, very particular with their mortgage insurance. And so the lower credit you are, the higher your mortgage insurance payment is going to be, the higher your debt to income ratio, the higher your mortgage insurance is going to be as well. So usually conventionals, the best option, because FHA is so competitive now with their mortgage insurance where they weren't in the past, conventional may be the best option usually if we have two borrowers and they're both over 700, because now I can basically, when I'm pricing out that mortgage insurance, I can add both borrowers' credit scores on there, and now I'll get a favorable mortgage insurance payment. But usually, if you're at, they're so strict that if you're at basically let's say 720 credit score, 40% DTI, your mortgage insurance is probably going to be right around, if you're doing 5% down, right? Assuming the lower down payment, because that'll also adjust the mortgage insurance. You're doing 5% down, your mortgage insurance will probably be right in line with what FHA is, even at a 720 credit score. That's how strict conventional has become, especially very, very recently. Where before FHA was at 0.85, now you have a little bit of room if you go conventional, but that's usually the biggest difference. So we'll look and we'll do both options. Obviously, if they're going for a condo, hey, take the higher payment because you're gonna save it in the headache that you're gonna get trying to get an FHA condo approved. So VA, 0% down, low interest rates, no mortgage insurance at all. So there is a fund. The VA does have a funding fee, and some veterans are exempt from that. Depends. Once we receive that certificate of eligibility, we'll know. But that funding fee is kind of like FHA's upfront mortgage insurance premium that gets financed into the loan. It's the same thing. It's usually about 2.3% is the funding fee, but there's no actual monthly payment, so it helps with their DTIs. Closing costs still need to be paid by the borrower, but they can also get 100% gift as well from someone else. Basically, the only appraisers that go out are actual VA certified appraisers. Only program where you can actually get cash back at closing. So, if you get too much in terms of gift or seller credit or anything like that, you can get money back at closing. The co-signers can only be spouses, okay? And they married, by the way, married. State of Florida, married. And that's very important because a lot of times, people want to, they're a veteran and they want to do a loan with someone else or for their child or whatever, and with their child and utilize their VA loan. You can't. It has to be specifically your husband or your wife. There are very, very, very few exceptions to that rule. And that's typically if, let's say, the veteran is disabled and the daughter takes care of the veteran, right? And the benefits are going to the daughter for the veteran, then at that point, then yes, technically they can both be on the loan because you are responsible for the veteran and you're going to be taking care of him in that property. So those are usually the exceptions that you'll see. There is a property tax exemption for disability vets. So if you are 100% disabled, we can price out on our end for the loan that your taxes are going to be $1. Okay, because technically speaking, you do not pay taxes if you're 100% disabled as a veteran. So I don't have to escrow any taxes. So without any mortgage insurance, without any property taxes, your pre-approval could be much, much higher than somebody else that's doing FHA or conventional, because there's two things that you're not paying for. If you're 100% disabled, you're not paying for those property taxes. And of course, VA comes already with no mortgage insurance. So pretty cool. Dr. Carla asked, if the vet is deceased, can the spouse still use the VA loan if they haven't remarried? Yes. So usually that would be another case. where the spouse would actually be able to get the certificate of eligibility directly from the VA. So bank statement / 1099. This is more for self-employed borrowers. No problem, Dr. Carla. This is more for self-employed borrowers, or really only for self-employed borrowers. There's no need for somebody that's W-2 to try to do this route, because you pay taxes on everything. So it's not going to be, it's just not available for them. It's only specifically for anybody that's going to be 1099 contracted or an actual business owner. And you still have to be in business at least 2 years. Even if I'm only asking for 12 months of bank statements or 1 year of 1099, you still have to have history of 2 years. I do not believe so, Vina. I never had that scenario, but I don't believe so. That COE will not be eligible for anyone if the vet and the wife are both deceased. Tamara, you had a question?
Yes, hi, good morning. I do. So if the vet is deceased, the certificate follows the wife?
As long as she doesn't remarry, yes.
Okay, thank you.
No problem. This is for primary residence, second home, or investment properties. Credit score as low as 620. There is no tax returns needed. Actually, if we were to put tax returns in the file, the loan would literally get declined based off of just that. That's how strict they are with not wanting to see the tax. You could do as low as 10% down is usually the lowest that you'll go on these bank statement programs. The gift funds are welcome, but the borrower does have minimum contribution. Typically around 5% is the minimum contribution that the borrower has to come in with themselves. So remember, conventional FHA, VA, they can get 100% gift. On this one specifically, they do have to have or come in at least with their own funds, specifically 5% down, usually. Cash out refinance, usually up to 85%. So if you want to take out equity on your property, you can do that as well. You can do a recent foreclosure, bankruptcy, or short sale as well. So I didn't put, this is part of the bank statement program in and of itself, but I'll kind of also talk about just, if you are W-2 and you have this situation. So usually, within the bank statements 1099 program, you can have a foreclosure as recently as 24 months ago, and you could still qualify for this program. But it's also the same thing within this, bank statement / 1099 program. This is considered a non-conforming loan. You also have somebody that could be W-2. They have clean income paperwork, but maybe they did have a foreclosure or bankruptcy or short sale a certain time ago. They can still qualify as W-2. It may not be a bank statement or 1099 program. It'll be a full document program. The only difference is they technically can go FHA or conventional because they have a recent foreclosure or bankruptcy. Well, they can do a non-conforming loan and go that route as long as it's been 2 years on a foreclosure or short sale. They can do it right away if they just discharged a Chapter 13, so there's no seasoning period on that. And I think Chapter 7 and 11 is either 12 months or 24 months, one of the two. But if they had a recent issue and they've already gotten their stuff clean and in order, they'll be able to buy a property. Maybe if they're W-2, not bank statement or 1099, but still utilizing the same company that does these non-conforming loans. So DSCR, debt service coverage ratio. I actually have one that went under contract very recently that we're working on. So this is for investment properties only. It's only for investment. We cannot utilize this for a primary residence. Minimum is usually 620 credit. There is no income or employment verification needed at all. We do not put anything on the application that pertains to their income or their employment. Usually as low as 20% down for purchases. You could do a 30-year fixed or interest only payments. Usually as an investor, if you're looking at this for the long term, maybe you want to do interest only payments to keep that payment as low as possible. And then when rates come down, refinance and then do a 30-year at that point, because maybe you don't want to do a 30-year on, because right now rates on these are probably going to be at about 8.5–9%. Right. So as an investor, you're trying to keep as much cash as you can short term. And then when rates dip, maybe you refinance into a 6 or something like that, utilizing the same program. And that could be a kind of way to do that. That would be one of the few reasons to do interest-only payments. No prepayment penalty option available. So a lot of these loans do have prepayment penalties. Usually, anywhere between 3 to 6 months of your mortgage payment or your principal and interest. So if your principal and interest is $1,500 a month, 1,500 times 6 months, that would be your prepayment penalty if you pay off the loan within 3, 4, 5 years. There are options. Typically, the rate is higher if you do a no prepayment penalty option. Rental income needs to be at least 75% of the proposed mortgage payment. So usually I put this on here because it's technically true, but the easiest way for me to tell you guys is as long as the rent is the same amount as the mortgage, the buyer will qualify for the loan. That's pretty much all we're looking at is credit, assets, and if the debt covers the ratio, right? Debt service coverage ratio. The debt is covered by the investment. So if the investor is an experienced investor, can 10% be considered? I'm pretty sure there's very few exceptions on the amount of down payment, and it really depends on which type of bank we're going to be doing this with. If we're going to be doing it in-house, probably not. But if we're brokering this out, because we do have both options, I may be able to get somebody if we can show proof that they have a bunch of properties and they have great credit, like everything is pristine for them. Maybe we could look at possibly lowering it to 15%. 10% would be a stretch, but that is really usually on a case-by-case basis. Typically you see as low as 15% on these DSCR programs. 20 is usually the standard. Can investor live in the investment home? No, that's a primary purchase. But to answer your question without answering it, you tell me it's an investment, that's the way that I do the loan. I hope that answers your question. Typically have to already own a property. So a lot of these programs, or a lot of these people that do these programs, they want to see that you already have a primary residence already that you're living in. There is exceptions for this, kind of the same thing, depending on the bank, depending on the the lender that does this. You can get away with not owning a home at all and going straight to buying an investment purchase. The one bank that I know that offers this, their minimum is 30% down at that point. Obviously, much less risk for them, but it can be done if you do not own a current property. But most of the time, they do want to see that you do have a property. Okay. So contract to close. This is very basic outline of what it kind of looks like once we go under contract. But I'm really going to kind of break down everything step by step here. I just didn't want to make 5 separate slides for that. So once we get the contract in, right, the contract goes to the loan officer, and that's when they work on disclosing the loan, right? So they have to make sure that the application is already 100% complete, which typically at pre-approval it is. And they will start getting or making sure that the rate for that day is locked in and different things like that. And usually the biggest delay that can come from the loan officer disclosing to the processor, besides the loan officer just being lazy, is the buyer not giving us updated documents, right? Which is very, very important, because if that buyer's been looking for 2-3 months, right, now the pay stubs that I have are 2-3 months old, the bank statements that I have are 2-3 months old, I need to get that stuff updated, right? Or maybe at pre-approval, I said, hey, you're pre-approved, but don't forget to get me that thing, and they never got it to me, and it's not something that's going to destroy the loan, right? But it's something that we need documentation-wise to get it to the processor. Maybe it's an income-driven repayment plan that they told us that they were in, right? That we just need the paperwork for, different things like that. So that would be the biggest delay from getting that those disclosures going over to the processing aspect of it. Is typically if the borrower needs to send us any documents that they didn't at pre-approval, or updated ones, right? At pre-approval, they may have said that they were getting a gift from family, right? At that time, we're not going to ask, hey, give me your mom's 1-month bank statement, right? Say, okay, does your mom have the funds in her account? Yes, she does. You already confirmed this with her? Yeah. Okay, now under contract, hey, by the way, remember you're getting that gift. Now I need that because I need to send it to the processor so the processor can send it to the underwriter, right? So from there, we go into processing. Once we get all the updated documents that we need, we make sure that that file's disclosed with the correct program that the buyer is going to be using, and sending it over to the processor. The processor is kind of the middle person between the loan officer and the underwriter, right? They're going to re-review what the loan officer did, make sure everything's in line and nice and pretty for the underwriter, so that the underwriter, when they go in, right, they get a good feeling, and they give you a favorable outcome with that loan approval, right? So usually this step from processor to underwriting, about 2 days, if that, realistically speaking. And then from the processor to the underwriter is usually about 2 days. From underwriting to loan approval is usually about 2 days as well, right? So the underwriter is going to review that file, make sure that we've got credit, income, and assets in there that are already verified. Make sure that this is an actual property, and they're not buying a lot or whatever the case is. They're going to do their due diligence on underwriting that file. And then there's going to be things that they have questions on because they haven't spoken to the borrower, right? The underwriter never speaks to the borrower. So they're going to have questions on specific things that they see. And that's when they're going to come up with what's called a conditional loan approval, right? And then within that conditional loan approval, there are conditions, okay? The underwriter, we may still not have the appraisal back, right? Because we had such a great borrower that we got this loan in within 1 day, right? Processor got it in within 2 days. Underwriter did the loan approval within 2 days. So you're talking about 5 days. Appraisal may not be back yet. So they may be asking for making sure that we get the appraisal in, right? And it's within the actual purchase price of what we have on the application. We definitely usually don't have title in by that time, right? So making sure we get title, the title's clear. There may be questions on some sort of deposits that the client may have on their bank statement, right? Hey, where did this come from? Why are you getting so many Zelles from Jeff? What is this? Different things like as well, maybe their income. Their income is on their pay stubs. The 2 pay stubs that they got do show full time. And we submitted this and we told the processor and the underwriter, hey, this person took off maternity leave late last year. So that's why her W-2 from 2022 doesn't correlate with what it's supposed to. And it looks like she had declining income from 2021 to 2022. The reason is because she took maternity leave. Well, the underwriter may say, okay, that's fine. There's a condition for making sure that we get documentation from the employer, or not documentation, just verification from the employer that did happen, so that can be clear. From conditions, once we get all of those conditions in, some of them may be internal, that we may have like this thing that we call data verify, which is making sure it's like almost like a background check on the client. Any address that they ever lived at, any home that they ever owned, if they did go through any sort of issues in the past, if they have a judgment on them or anything like that, that would come up on that data verify. And so those things would be internal things that we would have to overcome and stuff like that. Once we get all of those conditions in, then we're going to go ahead, submit it back into the underwriter. Usually the underwriter takes usually about a 1 day once we resubmit it back in. And then from there, we get to the underwriter will review it, give us a clear to close, or they'll say, hey, this condition was not met for this and this reason. Now we need to get it. So now we have to go back. There's another condition. And that's usually this condition gathering stage is typically the longest period that we see, because it could lead to some back and forth on some conditions sometimes, depending on how difficult that file is. And usually I would say anywhere between 7 to 14 days, give or take, depending on how fast or slow the client is, because it really is dependent on the client in this condition gathering stage, as well as other third-party things like title, maybe getting the condo documents as well. If this is a condo association, right, we need to make sure that we get the condo documents in and stuff like that. So it could be very, very quick. It could be quicker than 7 days, or it could be very, very slow, depending on this kind of file and how difficult it is and what conditions we need to gather. And then from there, once we get the clear to close, we send it into closing. And so once we get that CTC, doesn't mean, okay, I'm going to go to the title company and start signing. No, there's one more step that happens that a lot of people don't consider. It's the closing step, right? It's from when the closer of our closer and the title company's closer, they get together, they say, hey, this loan is clear to close. Let's balance out the closing disclosure. Let me make sure that we have all the documents that we need for the borrower to sign at closing, right? And so that's what the closer's job is. Once we get the clear to close, they're jumping in, they're making sure that the numbers match up to the exact penny with the title company so that they're not overcharging the borrower or undercharging the borrower. And so they'll line up all of those fees. Maybe the title company, has come across some fees that the lender doesn't know about. A lot of times when an association is involved, if you're doing a condo, there may be the association may require the client to pay association dues up front. I've seen where they even require like an escrow deposit. Associations like 6 months or 12 months of your association dues, where the association literally holds it and they don't give it back to you until you sell the property. So those are things that we're not going to know as a lender, because the association doesn't send us the estoppel, they send it to the title company. So different things like that, that the closer is going to make sure that gets finalized. And then once that stuff is done, then we go ahead, we schedule closing, and we get to the closing table. So Candace, you asked, what is the typical time frame range from contract to close? It does depend on, it varies by lender and by bank. Realistically, with us, we're about 20 days, give or take. And it really is this part here, this condition gathering stage is usually the biggest, because from the beginning to all the way to here, you're looking at maybe a week at most. Let's say the client takes a couple of days to get us what we need. The processor's still usually really good on that 2-day. Underwriter's really good on that 2-day. So you may look at, 6 days. We're getting our loan approval very, very quick. Now it's this part that usually takes the longest, which is us chasing down these conditions, usually from the borrower specifically, or maybe from third parties, whether that be the condo association or title or anything like that. So appraisal can come in one of two ways, either as is, meaning that there is nothing that needs to be done on that appraisal, or subject to, which means there are repairs that need to be done. And the appraisal is dependent on the repairs being done, and the value does not increase. Okay, I've had this question in the past where, hey, once these repairs get done, does that mean that the appraisal is going to come in higher? No, it just means that we can close. That's all that means, right? So it does not increase the value. It just means that the appraiser went there and they said, hey, I see some mold, right? We need to get a mold inspection done because it's an FHA loan. Or, even if it's conventional, hey, the backsliding door doesn't work, that needs to be fixed. I've seen that on appraisals as well. A lot of people think that FHA is very, very strict. There's things that just need to be done, whether it's an FHA loan or a conventional loan. The biggest difference between an FHA loan and a conventional loan in terms of the appraisal is that FHA looks more towards safety features, right? So making sure that all the appliances work, making sure that there's no wood rot or termites or mold is usually the three biggest things that are really going to differentiate FHA from conventional, which, to be honest, you don't want your client to deal with anyway, right? Can we have all the slides when we're done? This is really some good information. Of course, Tamara. I know that I'll send it over to Nikki, and then that way she can send it over to you guys. Some notes here. Good practice to always require seller to close any open/expired permits that could come up. Safety / structural damage is not good on any appraisal, like I mentioned, whether it's an FHA or conventional. And if we're doing an FHA loan, need to make sure that this is not a flip within the last 90 days. Typically, I catch that as soon as we go under contract, but most of the time, listing agents and even investors know that, because if they're flipping it, they're an investor and they know, okay, we can't accept FHA because we just bought this 45, 60 days ago. And guys, 9 times out of 10, the appraiser is right. Okay, I don't, very, very few times, and I'll look at it, right? But as soon as I see an appraisal come back lower, honestly, most of the time, I'll review it and I'm like, yeah, like I send it to the buyer's agent, the listing agent. I'll tell you guys, hey, I'm going to have to, negotiate this or whatever. And then there's some times where the listing agent just wants to get a dispute done. And I actually have a good scenario for you guys. So let's get out of this. So this appraisal was done. This has been a couple months already. But this purchase price that we had here was 445, right? Can you guys let me know if you guys see that, just to make sure?
Yeah, we can see it.
Perfect. Okay. So the sales price was 445, right? And when you're looking at the appraisal, you really want to get to this part. If you get, if it gets sent to you, is this part. It looks literally always going to look like this, where you see comparable sale number 1, number 2, number 3. And you're going to go scroll to the bottom here. And then this is where it's going to say as is or subject to. And then it'll, name the repairs that need to be done. As is means it's good to go. And look at this appraisal, came in at 414, right? Purchase or sales price was 445. Before we go under contract, or even before the appraisal comes in, typically we are depending on the agents to know more or less if that appraisal is going to come in, because you guys typically do your comparable, your analysis anyway, to make sure that you're coming in at a competitive price point. So I don't look at it until the appraisal comes back and, really do or do a deep dive on this. But this one specifically came back at 414. We're talking about $30,000 below what the actual seller wanted. And so we had some comps that were sent over to us from the listing agent, and they were here. There's 3 of them, one at 459, it was a 3.2, 1970, one at 460, 4.2, and then one at 400, 3.2. Okay, so I come here and I look, and where's my email to her? Here it is. And so I did some due diligence as well, and I looked at it. I submitted I looked at the comps that they sent over, and I made them my notes before I even submitted this appraisal dispute, because 9 times out of 10, the appraiser is right, right? The first comp you sent is more than 1.5 miles away from the subject property, and won't be the best one to use, as there are closer comps to the subject property that sold recently, right? So here on the appraiser's report, you see that they used a comp 0.21 miles away, 0.32 miles away, 0.30 miles away. What the hell do I look like sending a dispute on a property a mile and a half away saying, use this comp? That's ridiculous, right? The second comp actually will hurt us, not help us. So not sure if we should even include it. Reason being is it sold at 400,000, and this one was the one that I was talking about. I think it was the 3471. Yeah, the last one that was on the list here. It sold at 400,000 with 400 more square feet than the subject property. On the appraisal, he made adjustments based off of square footage. So this would give us an adjustment of about 380K based off the square footage. So that one was what, 1,733 square feet. This is our subject property is 1364. So if 1,700 square feet sold at 400,000, and now we're going to do a deduction of 400 square feet, right? You're looking at, he did a deduction here of 28,000 for 600. So you're looking at about 20,000 for 400, give or take. That would give us that 380 on that comp, right? Doesn't make sense to submit that. And then the third comp is the one he actually is using on the appraisal report and giving it the most weight so that it can even help us get to that 414 price point. However, it's adjusted because it has considerably more square footage than the subject property. So one of the comps that she sent us, she didn't even realize it, is the first comp that the appraiser is using, 3501 Northwest 33rd Ave. 3501 Northwest 33rd Ave. The appraiser is literally trying to help us here as much as he can, utilizing the one sale that was at 460, because everything else has been below that, 390, 370, right? And so they're trying to help us as much as he can, but he realistically, hey, this one was completely upgraded. This one is 1.5 times the size of the subject, but I could still give you a gross adjustment of about 410, right? So they made their assumption or their listing in this case for this appraisal based off of this sale without realizing that also as well, there's an extra bedroom, okay? And that it's 600 square feet more. And the appraiser didn't even ding for the extra bedroom, which I believe he should have, right? So in this case, the appraiser actually helped us get to 414 because this should have been probably closer to about 400,000, give or take, because this one that was 0.32 miles away sold, oh, this one was, so this, when was this appraisal done? 390, 370. We have, well, my opinion, we really don't have any business being at 414. So I sent it back to her. I didn't even submit the dispute. I gave her my points and I said, let me know what you want to do. And she emailed back and she said, I'll talk to the seller about lowering the purchase price. And so they agreed on 414,000, and the buyer still got seller credit as well, right? So that's my point. When I'm trying to get to is 9 times out of 10, the appraiser is right, right? My client had a purchase of 220, appraisal came in at 174,500. Teshka, I'd actually like to see that appraisal, and I'll actually go over it with you too to let you know how that appraiser got to that number and if we can fight it. Because I'm actually have a winning record against appraisers because I really know when to pick my battles, and you know what to kind of pinpoint. And it happened a lot in 2020, 2021 when everybody was buying or everybody was refinancing, and those appraisers were nonstop, and they messed up a lot. And so you can kind of pinpoint and see where their screw ups are, but they typically don't screw up that often. Oh, he kind of, look at that. You see? So even you realize that 174,500 was probably generous of him to do. Okay, so some concerns that we usually see: employment changes, recent student graduates. So if they just finish college, they don't need to work at a place for 2 years, right? They can do it. I like that this thing is here. They can apply right away with just an offer letter, and this says here they're eligible for purchase after 30 days of work. We have been able to get the pre-approval with the offer letter, or go under contract with just an offer letter and close with only one pay stub, and sometimes no pay stubs, as long as we have that verification of employment. And then we'll ask the client for the pay stubs after closing. So typically it's what we consider that a prior to purchase or a prior to sale condition. So before we sell this loan to another company, we need to make sure that we add the pay stubs in after, but we're not going to delay closing for it because we got the verification of employment from the employer and we have the offer letter as well that matches, right? And that may need to be a quick closing, maybe 2-3 weeks. We can't wait for 2 pay stubs. W-2 worker quits to start a new business or 1090 or goes to 1099. Maybe they're in the same industry, but they went from W-2 to 1099. They will not qualify. Okay. You must have 2 years of self-employment. There is exceptions to that as well. Usually that exception is if you went from W-2 to 1099 and you're within the same line of work, right? So you were an electrician for a company, W-2, and now you are with a small mom and pop because they're paying you more. You're their head electrician or whatever the case is, but now you're 1099, right? Because they can't afford to pay you W-2. You can go get away with 1 year 1099 or tax returns on that. And same thing will apply for if you started your own business. Typically, you need 2 years. You can get away with 1 year if you have history doing the same thing in the past. However, when you're looking at that 1 year, it's very, very tough because it's something where the application actually has to tell me that it's okay. It's not something that I can tell you off rip. Hey, we're good to go. Don't worry about that, right? If it's FHA is more black and white. I could tell you, yeah, I can get away with it, right? Explain it to the underwriter. Same line of work. FHA says we can use 12 to 24 months. We're good to go. On conventional, DU is much more sophisticated on conventional than it is with FHA. And so when we run that DU will tell us if we need 1 year or 2 years self-employment from that borrower. And so I won't know that until I actually run the application if we're trying to do conventional at that point. But usually you can, have some sort of exceptions on that 1 year. Credit / rescore. If borrower scores come back low, we can, do a rescore to increase within a couple of days. And I know some of you guys already, know about kind of how rescores work and stuff like that. I had a closing not too long ago with one of my realtors that I called the impossible loan, because the turnaround time of this was ridiculous. So same thing, client was pre-approved, and he was pre-approved for a while, to the point where his credit report was about to expire. So before we submitted it into process, we asked him, did anything change? Said, no, everything's pretty much the same. Well, we pulled credit, and of course, his wife's, not his, took a hit. And so now, since we need her on the application in order for qualification, she was like at 580s, and they were trying to utilize Hometown Heroes, which you guys know, 640, because he was a veteran. So we had to get her from 580 to 640 while we were under contract, and we did that, and we closed it. Like, it was like literally like 2 weeks. Within about 2 weeks, we got it from 580 to 640 and closed the loan. It was amazing. So the rescore option really does work. And we typically don't want to do this when you're under contract, right? We don't want these surprises, but sometimes it happens. One of the most important things I can tell you is, do not advise borrower to pay off credit card debt, or any debt for that matter, without consulting your loan officer, because they're just guessing, and they may be wasting money for no reason, right? They may think, oh, my DTI is too high, or they may think, oh, my credit's too low, or anything like that. Or I know for sure if I pay down this credit card that my score is going to increase, and it may be a completely different credit card that needs to be paid off, or an installment that needs to be paid off at that time. So if they're thinking about doing that, tell them, wait, actually have somebody run your credit and see what actually would need to be paid off, and hold off on it. Because if it's not something that's going to help them increase their credit, and it's just DTI related for qualification and stuff like that, what we do is we basically put on the application that it's going to be paid off, and the buyer doesn't have to pay it until the day of closing, right? And you do this in the past, or I've done this in the past as well. We do this and say, hey, I can get you pre-approved for 300, or I can get you pre-approved for 350 if you pay this thing off at closing, and it's $5,000, right? And then the client will say, okay, I'll get it. I'll pay it off. And then I'll say, don't pay it off just yet. Because when we're doing that pre-approval at 350, doesn't mean that, one, we know for sure you're going to go under contract at 350. And number two, we don't know for sure what that payment's going to look like. Those taxes, you can find a property at 350 with taxes at $1,000 a year, right? Because that person has lived in that property forever. And at that point, you qualify without paying that debt off. So don't waste that $5,000 for no reason. Let's wait till closing to make sure that that's the only way that you need it to qualify. Sourcing funds, large cash deposits into bank account will never count for available funds for closing. Okay, Anti-Money Laundering Act, and that's a huge red flag. So the underwriter will just minus out any sort of cash deposits they see. So if you have $25,000 in your account and $5,000 of that was cash deposit, that means that technically speaking, you only have $20,000. Okay. There are certain very minimal exceptions that can be made. Okay. Typically, let's say you sold a car and you sold it to another person. You didn't sell it to Carfax or anything like that. And they gave you a check or something like that you deposited into your account. That can be sourced with the bill of sale, showing that the transfer of ownership for the car was, directly in the same person's name that gave you the check. And that the same exact amount that was on the bill of sale and on the check was what deposited into your account. So it's like a lot of paperwork that would have to go into it in order for stuff like that to count. Okay. There is, let you guys in on a little secret here. Okay. If that person's self-employed, or they have a business that's actually on SunBiz and they have a business account, and they get a deposit through there, you can have them get an invoice for it, right? It just can't be an outrageous deposit, and just on average, they're doing $5,000 a month in business income, and then all of a sudden they got a $20,000 wire or whatever, right? Has to be something that's within those lines, but you can utilize it that way. If you need to get out of a sticky situation, you can tell your loan officer that might help them out on that. Contract tips: always be aware of your loan commitment date, and extend your loan commitment date when you're extending your closing date. So if we need to extend closing, I would also usually suggest that you extend your loan commitment date as well with it, because you never know what's happening. Typically, we're extending closing because usually we're extending the loan, or there's something with the financing that needs to be done, right? So just make it good practice when you're trying to extend the loan commitment period, the closing date, that you also extend the loan commitment period, just to protect your buyer realistically. Check off the correct financing program on page 2 of the contract. So if we're doing FHA, check it off. If we're doing conventional, check it off correctly. The biggest thing that I could tell you that messes us up on the loan officer side when you're doing that contract is the amount of down payment that you put that the buyer is going to do, or the amount of financing. You know, sometimes you're writing that contract up and you're putting 90% financing or something like that. And then the listing agent calls and says, "Hey, I see the buyer's putting 10% down," and I'm like, "No, they're putting 3% down. They're a first-time home buyer," or something like that, or 3.5% down FHA. And so that kind of catches us off guard. We don't want to make you look bad. So if that is something that you guys do on the contract, maybe to get it accepted or anything like that, just let us know. So that way, if we do get a phone call or if it does come up, we already have notes to let them know. Yeah, the buyer's gonna do whatever. It doesn't matter, right? People think that because you put more down payment, that the qualification from the underwriter is going to be easier. It's the same process no matter what. And then of course the borrower has to apply for the mortgage as soon as possible. Okay, so that's pretty much mortgages 101.